The Central Bank of Kenya is seeking to raise a total of 65 billion Kenyan shillings through a reopened 2-year bond and a top sale of 5-year and 10-year bonds. The 2-year bond, expected to raise 40 billion Kenyan shillings, will be on sale until April 17. The auction for the 5-year and 10-year bonds, expected to raise 25 billion Kenyan shillings, will be closed on April 4 or earlier if the target is reached. Professor Iraki, Economist, University of Nairobi, joins me to discuss this. Professor Iraki, it's nice to have you around on the show. Professor Iraki, are you there? So basically, we will be looking at the issue around the new bonds that have been reopened by the Central Bank of Kenya and what it can achieve for the country economically. And there have been questions as to if people will be tapping into this for dividends, or if the Kenyan government will be able to raise the needed revenue to push its various expenditure. Professor Iraki, are you there?
Hi, good morning. How are you?
Okay, it's nice to know that you're there. Now, quickly, what insights can you provide into the Kenyan National Treasury's decision to reduce net domestic borrowing targets for the upcoming financial year, and of course, its impact on government debt management?
I think if you remember when the present government was campaigning to get into power last year, one of the key things, 2 years ago, one of the key things they were debating about is making sure that we reduce the amount of debt that the country is taking. And the government has been prolific in trying to stop that. So when the government started auctioning treasury bills and treasury bonds, and the rates were going up, the government said, no, we are not going to accept paid beyond a certain interest rate. So what I see is the government trying to put its foot down and saying that beyond a certain interest rate, would rather get money from another source instead of from debt. And that source happens to be, in my opinion, tax. So I think the government is becoming bold in saying that the interest rate will not go up beyond a certain point, because it's going to become very expensive for the economy. And I think the alternative might be getting more taxes to take care of the shortfall.
Okay, but then why reopen a 2-year bond instead of simply issuing a new one? And is there a risk that the top sale for the 5- and 10-year bonds might not reach its target of 25 billion Kenyan shillings by April 4?
I think that's the risk the government is facing, because one way to attract people and make them lend the government money or borrow more money from the government is to raise the interest rates. And if you look at the auctions the central bank has been having in the last few months, they have not been meeting the target, because the investors in the government paper seem to know that the government is looking for money and really want money. So they are trying to, I would probably call it, twist the government to give them better interest rates. But the government is saying the interest is too high. So they are negotiating, and that's why the government is reopening these bonds, hoping that they can get the same money at a lower rate. Whether that is going to happen, we can wait and see.
Now, you said that targets are not being met, but then we see the Kenyan National Treasury setting a target for net domestic borrowing for the year 2023-2024 financial year at 422.7 billion Kenyan shillings. So does that mean that this also might not be achievable?
That's an interesting question, because the government had promised that they would stop borrowing from the domestic market. And that is why we ended up going to Europe. Because the thinking was that you are going to get cheaper loans in the international market than domestic market. But that's not always the case, because if you remember when we repaid back the Eurobond, we found it very expensive to float another bond in the international market. So probably the government found that it is more prudent to get money in the domestic market. 400 and something billion, are they going to get that? They may get, but I'm not sure, because the appetite for higher interest rate is very high. So if the government offers a higher interest rate, I think it is possible to get the 427 billion it is looking for in the domestic market. If the rate does not go up, it might be a hard target to meet.
So then, can the Central Bank of Kenya find the impetus to control interest rates from the reduced Eurobond maturity risks?
I think that is possible now, because once we pay the interest, once we paid the Eurobond, the market was very exuberant. The market was very happy. That's why even the sharing has been appreciating because it is cheering up. So I think with the risk of defaulting on the Eurobond now under behind us, I think it is now possible that the central bank will be able to control the interest rate and they go a bit down so that the cost of the foreign debt and domestic debt is not as high as expected. But we are not sure about that because there could be other headwinds. But for now, we think the central bank has built the momentum to control the interest rates.
Okay. Now, we understand that knowing how the CBK plans to use this money can offer clues about the Kenyan government's current priorities and spending plans. So tell us, how will the raised funds of about 65 billion Kenyan shillings be allocated?
I think one of the priority areas of the government happens to be the infrastructure. The government has been very keen to make sure that the infrastructure projects like the roads, the highways, the streets are taken care of. So one of the boards that has been reopened happens to be the infrastructure board. And I think that's one of the priority areas that the government is targeting. I think the other areas could be areas like education, areas like health, areas that matter to the ordinary citizens as per the manifesto of the government. But we can only wait and see when the money is raised, and hopefully it will be put into the right use.
Okay, so I'd also like to find out as regards these interest rates and all, how does the rejection of expensive investors' bids fit now into the CBK's broader strategy for managing interest rates and government debt service costs?
See, it's a question of supply and demand. The government, the investors are demanding a higher rate because they know the government wants money. The government is saying this is very high interest rate. So there's a tussle between the people who want to buy the government paper and the government that is going to be rent money. The government wants lower interest rates. The investors or the buyers of the board want high interest rates. So I think there will be that tussle. But what I suspect is going to happen is they are going to settle into a rate that is commensurate with the appetite for risk by the government and the appetite for higher interest rates by the investors. But if the government gets an alternative source of money, maybe from IMF or maybe from taxes, I think it will be able to force down the interest rates. But as long as the government now needs the money, doesn't have an alternative, it may have to bulk and accept higher rates.
Let's quickly look at the issue around risks for investors. Now, investors need to weigh factors like interest rates, as you've mentioned, market volatility and creditworthiness of Kenyan government before making a decision. So what are the potential risks and rewards for investors considering these bonds and all these factors associated with the risks?
We must accept that once the crowd of Eurobond was gone, which was the biggest risk every investor was facing in this country, now people are seeing the market as very bullish. People are seeing the market as very positive. But I don't think the investors I can assure you the investors are very willing to come and invest in the Kenyan bonds and treasury bills because the rates are very good. So even if there are any risks in the Kenyan market, the rates are good enough to attract them. And I think the investors are feeling that the rate they are being given is commensurate with the risks they are taking. There are certain risks, political risks, but I think those have subsided. There have been risks from outside the country, like the war in. There have been risks like the war in Ukraine, the war in Gaza. There has been the problem of oil passing through the Red Sea, but those ones have generally subsided. So I don't see very big risks that that investors are afraid of. They are very confident now.
You said that you don't see risks emanating from these, but then we've seen declining interest rates in quite a while now, and some investors might just be a bit skeptical about making bids for these. Don't you think that would have a negative impact on the part of the investors who are actually looking at expectations in terms of interest rates?
Yes, I think the investors are in the market not just to give the government money, they want some certain returns. So if they feel the returns are not commensurate with the risks they are taking, even if the risks are minimal, they may not be willing to give the government money. Remember, the investors buying the government treasury bills and bonds have alternatives. And if they really think the alternatives are better than buying the government paper, they'll probably go there. But for now, I think there will be a tussle between the government and the investors as they decide to look for high returns and the government tried to reduce the interest rate payment and the foreign debt. But I'm sure along the way we are going to get a balance.
Oh, finally, let's just look at it in a bit broader scope in about just a few seconds. Now, understanding how Kenya's borrowing strategy compares to its neighbors can offer valuable context for the regional economic trends. So then, how does this bond issuance by the CPK fit into the larger picture of East Africa's economic landscape?
One of the dreams of the East African community has always been that the monetary and physical policies would be synchronized, so that what is happening in Kenya and the neighboring countries, the members of the East African community, would be discussed at the highest level. But it's not always that way. The East African community countries don't always have the same monetary and the physical policy. So there has not been very good harmony. But if you look at the neighboring countries like Uganda and Tanzania, their interest has been going down compared with ours. And maybe that's a lesson for the Kenyan government to borrow so that our interest can go down, stimulate the economy, and we have more jobs for the Kenyan people. So I think we are still very different countries despite being within the East African community. But I hope with time there will be some harmony on monetary and physical policy.
All right. Professor Iraki, Economist, University of Nairobi, it's been a pleasure having this time shared with you. Thank you so much.
Thank you and have a good afternoon.
Yeah, and you too.